Hello there, welcome back to our series of lessons on Introduction to Financial Accounting. Today we are on lesson number 13, where we'll talk about the statement of cash flows, having talked about the income statement in lesson number 11 and the balance sheet in lesson number 12. Now today we're going to talk about the statement of cash flows. Okay. So without wasting time, let's go right into it. So what is a cash flow statement? What is a cash flow statement? As the word itself suggests, this statement is all about showing the cash movements in an organization, cash inflow and cash outflow. Okay, so cash inflow, the cash that comes in the business, the cash outflow, is the cash that leaves the organization through various ways of doing daily transactions. Okay, so the statement of cash flows is the primary financial report that tracks the movement of actual cash and cash equivalents in and out of the business over a specific period of time. So this statement bridges the income statement and the balance sheet to prove a company's true liquidity in terms of cash position. Okay, so the statement divides the cash flows into three types: cash flow from operations, cash flow from investing, and cash flow from financing activities, as we're going to look at in details in due course. Okay, so one of the primary uses of the cash flow statements is to help to determine the company's current cash position. How much cash does the company have at that particular point in time? Okay, so that said, knowing cash flows on its own isn't very useful unless you are determining an ending balance. For that, you need now the starting cash balance. Okay, so for a going concern entity, you look at the previous year's cash flow statement. The closing cash balance for the previous year will give you the opening balance for this year. So the starting cash balance will be found at the end of your previous cash flow statement. Okay, now let's dive into some key digestible cash flow concept that you need to understand at this level. All right. Okay, a solid presentation should be broken down into these key digestible concepts. So talking of purpose and importance under this concept, so one of the most famous concept under cash flow that you need to understand is that profit is not equal to cash. The profit that you calculated under income statement does not represent the cash position of an organization at that particular point in time. Okay, this is because an income statement uses what we call an accruals accounting concept, which we looked at this concept in one of our lessons where we were talking about the most common accounting concepts. So under accruals accounting concept, recording sales and expenses when they happen, not regardless of whether the cash has been paid for or not. Okay, so which means a company can be profitable on paper but still go bankrupt if the cash dries up. Okay, funny, but that's what it means, that profit is not always equal to cash. It's very rare for profit to be equal to the cash balance that a company has. Okay, so we also have a checkbook view. So the cash flow statement acts as simply a corporate checkbook showing exactly where the money originated from and what it was used for. And all those three categories that we looked at, and we're going to look at them each in details. Okay, so let's now look at the three core sections of the statement of cash flows. Yeah, so every cash flow statement is divided into three main activities, each detailing the different source and use of cash in that particular reporting period. Okay, so the first one, very important, is operating activities section. Okay, so under this section, we are looking at the cash that has been generated or spent when running the core business. Okay, it depends on what business you are in, but your core business, when you incur expenses or receive cash from your core operations, that cash is classified under operating activities. For instance, you talk of the cash received from your customers, or the cash you use to pay your employees, or the cash that you use to purchase your inventory for the basic operations of your business. So this is a primary indicator of a healthy and self-sustaining businesses, because if you are able to generate enough cash from your core operations, it means you have a healthy cash position to cater for your operating needs. And then we have the investing activities section. So under this category, we look at the cash that is used for or received from buying or selling the long-term assets like property, equipment, or other companies. Hence the word investing. So because if you're buying and selling long-term assets, it means you are investing. So those are investing activities. So under this section, a negative cash flow here is common for growing businesses, investing in future expansions, because they now use of cash to buy long-term properties and maybe other companies. And then we have financing activities, the cash flows between the company and its owners or creditors. Okay, so we're going back to the theme where we were explaining that this simply shows where the money came from and what will be used for. So it can either come from owners in the form of buying ownership in the business, or creditors giving credit to the business. So this includes raising capital, issuing of stock, paying of dividends, and borrowing or repaying debt. So all these are financing activities. Okay. Now having described what a cash flow statement is all about, let us look at a typical example of how a cash flow statement looks like. So we're going to look at the statement of cash flows for XYZ Corporation for the year ended 31st December 20X5. So assumption here is that all the numbers are in US dollars. Okay, let's start with the cash flows from operating activities. So in this case, we assume that our income statement was showing a net income or a profit of 50,000. But as we said, profit is not equal to cash. You can have cash which is greater than the profit recorded in the income statement, or the vice versa. So let's look at what we have here for XYZ Corporation. So from the net income, we're going to adjust to reconcile net income to net cash. Okay, starting with net non-cash items like depreciation expense. So here we are adding back depreciation because it is a non-cash expense. It was subtracted in the income statement to reduce the profit, but here we're adding back because we want to show the true cash position of the business. Okay, so we add back the depreciation expense, If we had amortization, we would also have added back. So assuming only had depreciation as the only and cash expense in this case. And then we also adjust for changes in working capital. So here they had an increase in accounts receivables. So sales made on credit. So if you have an increase in accounts receivable, it means you sold more goods on credit where customers promised to pay later. So this one is tying up cash. It reduces cash. So that's why we are subtracting. If we had a decrease, it would have meant that we had received more cash from our debtors, and then we would have added back the cash expense. And then we have a decrease in inventory. We sold the stock, thereby freeing up cash. So we sold stock, we received cash. So that is a cash inflow. That's why we are adding 2,000 there of sold stock. And then there was also an increase in accounts payable. We delayed the paying our suppliers, thereby increasing the cash in our hands. If it was the vice versa, we would have said we are now paying the suppliers, then it would have been a cash outflow and we would have subtracted. So here the net adjustment is 9,000, so which is a cash inflow. So the net cash provided by operating activities now has moved to 59,000. Okay. And then we go to investing and financing activities. So cash flows from investing activities. Here we had purchased an equipment which represents a cash outflow. We purchased an equipment by cash, 15,000. Therefore, we have to subtract 15,000. And then on the same investing activities, we purchased land, which is a long-term asset. So that is a cash inflow because we received a cash inflow of 5,000. So the net cash used in investing activities now is 10,000, which is a cash outflow because we have simply subtracted 5 from the 15,000 of the cash outflow. And then we go to financing activities. Under financing activities, we have to proceeds from issuing of common stock. So we have issued some common stock whereby people are subscribing to the shares of our business by giving us cash, 20,000. So that is a cash inflow. That's why we have a plus there. And then we also repaid a long-term loan to the bank. So that is a cash outflow of a negative 10,000. And then we paid cash dividends to the owners. That is also a cash outflow. Summing up then, we have the net cash provided by our financing activities of 6,000, which is a cash inflow. Okay. So if we go back to the operating activities, we had a net position of 59,000, which was a positive. So if we subtract the net cash used in investing activities with 10,000, we will remain with 49,000. And then if we add now the 6,000 net cash provided by financing activities, we come to a net increase in cash for the whole year of 55,000. So assuming the cash balance at the beginning of the year, 1 January, was 10,000 plus now the net increase of cash for the year 55,000, we have cash balance at the end of the year of 65,000. So as you can see, it's different from a profit of 50,000, which was reported in the income statement. So we can give more examples of the income, of the statement of cash flows, but basically this is how we present the statement of cash flows, and that marks the end of our lesson 13. Thank you for your attention. Don't forget to like and subscribe for more lessons. Goodbye.